All right, we're moving on to lesson 15.3, which is adjusting accumulated depreciation. Most businesses have several broad categories of assets in their operation. Cash and other assets expected to be exchanged for cash or consumed within a year are called current assets. Physical assets that will be used for a number of years in the operation of a business are called plant assets. It's funny, when I worked in a chemical plant, that made perfect sense to me because I would buy big pieces of equipment that we would plan on using for years and years and years, and it was an asset to the plant. Say a piece of packaging equipment or something to use in the mixing of chemicals. We would purchase that and sort of attach it to the plant floor, physically attach it to the plant floor to use in making of our soap or packaging of it, and it was called a plant asset. So some of 3 Green's plant assets are computers, cash registers, sales, display cases. Businesses have 3 major types of plant assets. They have equipment, buildings, and land. 3 Green records its equipment in 2 different equipment accounts: office equipment and store equipment. 3 Green rents the building and the land where the business is located. Therefore, the company does not need plant asset accounts for buildings and land. So we just talked about this. Most businesses use several broad categories of assets in their operations. Cash and other assets expected to be exchanged for cash or consumed within a year are called current assets. And then physical assets that will be used for a number of years in the operation of a business are called plant assets. A loss in the usefulness of a plant asset as a result of wear or obsolescence is called depreciation. Basically, they're going to be using whatever they just purchased that's considered a plant asset, and it wears. It gets old, it gets used, it starts looking bad, so they need to depreciate the value of it. For example, 3 Green bought a new lighted display case to draw attention to its products. The display case will be useful for only a limited period of time. After several years, most display cases become worn from use and no longer offer an attractive display. So a loss in usefulness of that display case as a result of wear or obsolescence is called depreciation, and we can calculate depreciation. To match revenue with the expenses used to earn the revenue, the cost of a plant asset must be expensed over the asset's useful life. They spread out the use of it. They spread out the expense, the decrease to earn revenue, the decrease in the value of the item. The portion of a plant asset's cost that is transferred to an expense account in each fiscal period during that asset's useful life is called depreciation expense. When you're in a manufacturing facility and you depreciate something over time, once its value gets to 0, it's easier to get rid of the item and replace it with something newer, something more useful. Okay, 3 factors are considered in calculating the annual amount of depreciation expense for a plant asset. The original cost, the salvage value, and the useful life. Original cost. So the original cost of a plant asset includes all costs paid to make the asset usable to a business. These costs include the price of the asset plus delivery and any necessary installation costs. The salvage value, an estimate of the amount that will be received for an asset at the time of its disposal, is called its salvage value. Salvage value may also be referred to as residual value or scrap value. Since salvage value cannot be known when the asset is bought, it must be estimated. And then useful life. The period of time over which an asset contributes to the earnings of a business is called its useful life. The total amount of depreciation expense is distributed over the estimated useful life of a plant asset. 2 factors affect the useful life of a plant asset. First of all, the physical depreciation, and second of all, the functional depreciation. Physical depreciation is caused by wear and deterioration from aging and weathering. And then functional depreciation occurs when a plant asset becomes inadequate or obsolete. An asset is inadequate when it can no longer perform at an acceptable level of efficiency. A new asset of the same design and capability might replace it. An asset is obsolete when a more modern asset, perhaps a new technology, can operate more efficiently and produce better service. All right, so we have 3 ways to calculate depreciation. First of all, straight line depreciation, recording an equal amount of depreciation expense for a plant asset, and each year of its useful life is called the straight line method of depreciation. We do just basic original cost minus the estimated salvage value. Our example, if we purchased the lighted display case for $2,500, the estimated salvage value at the end would be about $500. So the estimated useful life is about 5 years. So we do the original cost minus the estimated salvage. So the estimated total depreciation expense would be $2,000. We take that $2,000, divide by 5. So annually we can depreciate that display case at $400 a year. Or we can do the accumulated depreciation, the total amount of depreciation expense that has been recorded since the purchase of a plant is called accumulated depreciation. The amount accumulates each year of the plant asset's useful life. The depreciation expense for the current year is added to the prior year's accumulated depreciation to update accumulated depreciation. So we're at, for 2 years, $800, depreciation expense, $400, sorry, back up. Oh, these are years, silly me. So we bought that lighted display case in 2001, let's say. We're just going to make that X, a 0. So we bought the display case in 2001. So 2002, the accumulated depreciation, $800. 2003, we need to add another $400 to it for an accumulated depreciation of $1,200. So we lose $400 in 2001, $400 in 2002, we add another $400 in 2003. So in 2003, our accumulated depreciation is up to $1,200. And then the book value is the original cost of a plant asset minus the accumulated depreciation. It's its book value of the plant asset. The book value is calculated by subtracting the accumulated depreciation from the original cost. Makes sense. So this is the value in the books. It's an asset of the facility. All right, so after making calculations, 3 Green determined that the total depreciation expense for its office equipment is $7,485. The balance of accumulated depreciation office equipment on December 31st is $6,189. So the balance of that account needs to be increased by $7,485. The amount of the current year's depreciation. So the new value of accumulated depreciation, the new balance of accumulated depreciation office equipment is $13,674. So you add your total depreciation plus the new one, and it gives you the new balance. It's really important to retain the original cost information for plant assets. If depreciation expense for office equipment were credited directly to the asset account, office equipment, that account would no longer show the total amount of the cost of office equipment. The account would be reduced by the amount of the depreciation. So instead, depreciation is recorded in the contra account, accumulated depreciation office equipment. And I wrote that all right there. So we just have to retain the original cost information. We don't want to mess with that account because then we wouldn't know how much everything was worth when we first purchased it. So we have a contra account to handle the depreciation. And don't forget the 4 questions. I still have this one up from last lesson. All right. What is the balance of the account being adjusted? Accumulated depreciation, office equipment. It was $6,189. And then what should the balance be for this account? Accumulated depreciation, office equipment should be $13,674. That's where we did that addition. So we need to increase by $7,485. What adjustment should be made? Well, we're going to debit the depreciation expense office equipment by $7,485, and then we're going to credit accumulated, depreciation office equipment by $7,485. All right. This is what we talked about in the 4 questions. Our office equipment original balance, we need to increase the depreciation. Accumulated depreciation, take into account the new balance by adding that to the old one. And then store equipment. Okay, depreciation expense goes up. Okay, those are all the T accounts. But here is our trial balance. Office equipment shows what it originally is, the accumulated depreciation before we add the $7,000. Store equipment, and then accumulated depreciation. So we debit depreciation expense office equipment, credit accumulated depreciation, and the next one, which we actually didn't talk about. So that would be the store equipment. All right. Okay, what are the 2 categories of assets? Current assets and plant assets. What 3 factors are used to calculate a plant asset's annual depreciation expense? That's where we had the calculations. First we had the straight line method. Original cost, salvage value, and useful life. What plant asset account does not have a contra account for accumulated depreciation? Land. That wasn't in the lesson, so I'm glad we went over it. Land does not have a contra account for accumulated depreciation. How does an adjusting entry for accumulated depreciation affect the related plant asset account? No change. Okay, we want to make sure that we keep the plant assets steady. That's why we have an account for depreciation.